The 401k contribution had been set to increase every January, and by mid-April, the higher deduction was already blending into the background of his paycheck. He noticed it the way he noticed property taxes. Briefly, with a flicker of recognition, then with acceptance. The adjustment had felt responsible when he scheduled it the year before. Automatic escalation. A small percentage point more each year. The kind of decision that aligned with long term planning. At 46, the rhythm of his finances was steady. Bi-weekly pay, health insurance deducted before he saw the money, a dependent care FSA that emptied quickly, mortgage payment drafted on the first, utilities staggered across the month, a car loan that would be gone in 18 months, though another vehicle was already nearing 120,000 miles. College savings contributions transferring out automatically, modest but consistent. The increase in retirement savings had been calculated against a spreadsheet on a Sunday afternoon. He had projected balances at 65. He had compared scenarios. The difference between contributing 12% and 13% looked meaningful across 20 years. It closed a gap he preferred not to think about. By May, something else had adjusted quietly. The summer camp invoice arrived higher than the previous year. Home insurance renewed at a new premium after a regional rate adjustment. The grocery budget, once flexible, had become less predictable. None of it was dramatic. It was incremental. His wife's salary covered health insurance and most of the household utilities. Her district had negotiated a small raise, but the increase had been offset by higher contributions to the state pension system. They both had retirement accounts, though hers felt less visible. Defined benefit, formulas, vesting rules. His was a dashboard that changed daily. They had always contributed something to retirement. In their early 30s, it was minimal, then cautious, then more intentional. They refinanced once when rates dropped, shortening the loan term by 5 years. That decision still felt aligned with discipline. Paying down the house faster had been framed as security. Now the house had 13 years left. Their children were 11 and 14. College no longer felt abstract. The older one talked about out-of-state schools without irony. They had saved consistently into 529 plans, but tuition projections had moved faster than contributions. The January increase in the 401k contribution meant roughly $320 less take-home pay per month. It was not a shocking figure. It was measurable. It existed. In February, they had adjusted dining out. In March, they postponed replacing the aging sectional couch. In April, the HVAC system required a repair that exceeded the home maintenance buffer they kept in checking. The credit card balance revolved briefly, then was paid down with a smaller than usual transfer to savings. None of this felt like strain. It felt like compression. At work, he had entered the stage of his career where raises were narrower. Promotions were possible, but rare. His role was stable, respected, and kept within a range that did not expand dramatically year to year. Cost of living adjustments arrived most summers, sometimes below inflation. He remembered when increasing retirement contributions had felt like progress. The first time he reached the employer match. The first year he maxed out the IRS limit after turning 50 was something he anticipated. Catch-up contributions represented both age and opportunity. But in the present, the math was quieter. Every additional dollar allocated to the future was a dollar not allocated to the present structure they had built. In late summer, they sat at the kitchen table reviewing expenses before the school year. Supplies, activity fees, travel for a regional soccer tournament. The older child needed a laptop upgrade. The younger had orthodontic work scheduled, partially covered by insurance but still significant. The retirement contribution continued automatically. He noticed that his checking account balance no longer floated as high between pay periods. The margin was thinner. Still sufficient, still controlled, just closer to the baseline. The brokerage statements showed growth. Markets had performed reasonably well that year. The total retirement balance crossed a round number he had once considered distant. The number looked solid on paper. It did not translate directly to flexibility in September. His wife mentioned that several colleagues were delaying retirement because their pension estimates, while stable, did not cover rising health insurance premiums before Medicare eligibility. She said it without alarm. It was common conversation in the teacher's lounge. They had always assumed retirement at 65. It was a neutral target, far enough to accumulate, near enough to imagine. But the spreadsheet scenarios depended on sustained contributions and moderate returns. They also assumed that college expenses would not significantly interrupt retirement savings. In October, the older child scheduled campus visits. Flights and hotel rooms were booked. The 529 account was not yet ready to absorb 4 years of tuition, even at an in-state public university. They had expected to supplement with current income and perhaps modest loans. He began to notice the interaction between these timelines. Retirement contributions were increasing at the same time college withdrawals were approaching. The years from 50 to 60 would likely include tuition payments, potential car replacements for teenagers, and continued mortgage obligations. The logic of maximizing retirement savings made sense in isolation. Compounded growth over decades, tax advantages, employer match. It was the kind of behavior that financial checklist endorsed. But isolation was theoretical. In practice, retirement savings competed quietly with every other long-term commitment. There was no single breaking point, no dramatic expense that forced a reversal. Instead, there was a slow recalibration of what felt comfortable. In November, they reduced the 529 contribution slightly to accommodate a higher winter heating bill and a deductible on a minor surgery. The retirement contribution remained unchanged. It had been positioned as untouchable. At 50, he qualified for catch-up contributions. The option to add several thousand more per year into the 401k appeared in the benefits portal. He did not activate it immediately. The tuition timeline was too close. He found himself thinking in overlapping horizons. 5 years until the oldest graduated college, 13 years until the mortgage ended, 15 years until the traditional retirement age. Each timeline had its own financial gravity. The mortgage payment, once a dominant expense, was now simply embedded. Property taxes had risen gradually. Home maintenance projects emerged unpredictably. A roof replacement estimate arrived after a routine inspection. The number was high, but not shocking. It joined the queue of anticipated but unscheduled costs. Retirement balances fluctuated with market cycles. In one quarter, the account lost more than he contributed that year. In the next, it regained ground. The volatility did not alter the payroll deduction. He understood that consistency was the premise. Long-term investing required tolerance. He did not panic during downturns. He had lived through enough cycles to recognize patterns. What felt different was the simultaneity. Retirement savings were no longer an abstract future project. They were an active allocation competing with immediate, measurable obligations. At family gatherings, conversations shifted toward aging parents. His father had required assisted living for a brief period before passing. The cost had been partially covered by savings, partially by the sale of a long-held home. The experience had reframed the unpredictability of later life expenses. Long-term care insurance had been discussed once at their kitchen table. The premiums felt substantial. They deferred to decision. By 52, both children were in college. One in-state, one out of state with partial scholarships. The 529 accounts absorbed a portion. Federal student loans filled some gaps. They chose to cover housing costs directly to limit debt. The monthly outflow increased materially during those years. Retirement contributions continued at 13%. He had not increased them further. Vacations became shorter. Home projects were sequenced more carefully. The emergency fund was maintained, but contributions to it were paused during peak tuition months. He sometimes reviewed his projected retirement income replacement ratio late at night. The percentages hovered in the 70s. Depending on assumptions, it appeared adequate. It was not extravagant. The tension was not dramatic enough to provoke a change. It was persistent enough to be noticed. When the older child graduated and began repaying student loans, there was relief. The 529 withdrawals ended. For the first time in years, a portion of monthly cash flow loosened. He increased his 401k contribution by one more percentage point the following January. It felt like reclaiming ground. Yet, health insurance premiums had risen again. The car that had reached 120,000 miles was replaced with a modest new model financed over 5 years. The mortgage, now under 5 years remaining, still anchored the first of each month. At 58, he ran new projections. Delaying retirement to 67 materially improved the outlook. 2 additional years of contributions. 2 fewer years of withdrawals. Higher Social Security benefit estimates. The math was straightforward. His wife's pension projection was steady but not immune to inflation. They began discussing Medicare timelines in practical terms. Healthcare costs between retirement and eligibility remained a variable. The retirement account balance was larger than it had ever been. It represented decades of incremental increases. It also represented a series of trade-offs that had occurred almost invisibly. The choice to escalate contributions in midlife had been correct within the logic of long-term accumulation. It had also compressed other parts of their financial life during the same period. There had been no visible sacrifice dramatic enough to regret. No crisis triggered by the higher savings rate. Just smaller margins, postponed purchases, reduced flexibility. By 60, the mortgage was paid off. The absence of that payment created space. It felt tangible in a way retirement balances never had. Monthly cash flow expanded immediately. He increased catch-up contributions for 2 years before retiring at 66. The final working years were stable, unremarkable. Raises were minimal. Responsibilities steady. On his last day of work, there was no financial epiphany. The retirement accounts were fully funded according to the plan they had sustained. Social Security filing was scheduled. His wife's pension began the following month. The college years were behind them. The roof had been replaced. The cars were paid off. The house, now quiet, required less maintenance. Looking back, the years when retirement savings competed most directly with ongoing obligations were not the early ones, nor the final ones. They were the middle stretch, when multiple timelines converged. The automatic increase that had seemed small at 46 had shaped the contours of the following decade. It had narrowed some choices and protected others. It had not eliminated uncertainty. In retirement, the income streams arrived as projected. Market fluctuations continued, now with withdrawals layered in. Healthcare premiums became explicit line items rather than payroll deductions. The spreadsheet scenarios had approximated reality closely enough. There was no surplus windfall. There was no shortfall crisis. The long competition between future security and present obligation had resolved not with victory, but with endurance. The 401k contribution that once felt like compression had become distribution. The payroll deduction replaced by systematic withdrawals. The flow reversed direction. The obligations did not disappear entirely. Property taxes continued. Insurance renewed annually. Adult children visited with their own financial realities. The balance between saving and spending, once a question of percentages on a benefits portal, had been embedded into decades of lived structure. It had always appeared responsible. It had always carried consequences. And even in retirement, the numbers remained in motion.